Hello and welcome to our discussion on the financial statements. In this session we will try to understand one of the important features of the company form of organization and its impact on the financial statements, particularly on the balance sheet. So one of the important features is the liability of the shareholders is limited, or the limited liability of the shareholder. According to this feature, the shareholders' liability is limited to the extent of the capital and the profit or the retained profit. If the company is dissolved, the shareholders' personal property is not attached, or the debt holders cannot claim money from the personal property of the shareholder. Let us take a simple example to understand that. Sorry for that. Suppose this is the balance sheet of a company which has the assets of 500,000, and the 500,000 is in the form of cash, debtors and fixed assets, and these assets are financed by capital, retained profit and the debts. Suppose this company is closed, is liquidated. What will be the amount available for the debt holder and the equity holder? We'll see three different cases. The amount available for the debt holders and the equity holders will depend on the amount realized or the assets realized. Suppose in case 1 we say that the amount realized for the shares, the cash is the debtors is same, and 350 by sale of fixed assets also you got that much of money. So 500,000 is realized at the time of the. So if this is the money realized, of this money the first 200 will be the amount available to the debt holders, because the debt holders have claim on the amount first, and the balance will be taken by the equity holder, because the equity holder are the residual in nature, or the residue holder. But let us see the second case. In second case, the cash is same. The debtors we are able to realize only suppose 40%, and the assets you are not able to realize the entire money. You are able to realize only 50%. So the amount available is 265. If that is the case, the debt holders will get 200, whereas the equity holder will get the balance money. Okay, so in both the cases the debt holders are getting full. Now case 3, suppose I get 50 here. The debtors all become 0. Okay, that means no amount is collectible, and the assets we are able to collect only 50% by selling it in the market. So, or maybe less than that, because we already taken 50% in the previous case, 20%. So the money available is 120. Then the debt holders will get 120, and the shareholder will not get anything. But see, in this case the debt holder cannot ask the equity holders to pay. The liability of the equity holder is limited to the extent of the equity. But suppose in case 4, in case 4, suppose I copy the format. In case 4, we got the 50 debtors, cash, debtors 100, and market value of the assets suppose have gone up for 50. Because you revalued the assets and somebody is ready to pay for more, the debt holders will get only 200, because that's a liability. The equity holder will get the balance money. So the amount available for both the debt holders and the equity holder depends on the value realized. If the value realized is less, the debt holders will sacrifice or will not get that amount, because the liability of the shareholders is limited. So the liability of the shareholder is limited to the extent of the capital that they contributed and the profits that they have already there on the balance sheet. But if the asset realized is higher, the shareholders will get higher amount. So the residual amount may be much higher than the money that they have contributed or money that is there in the form of equity. The liability of the shareholder is limited, means limited to the extent of the money contributed or equity. The debt holder cannot sue the shareholders for the personal property if the amount realized by the debt holder is less than the amount that they have paid. Thank you very much.